Hi, everyone. Welcome to Zillion's Masterclass. This particular episode is going to we're going to focus on IoT, which is Samsara. Zillion is a platform to help you make great financial decisions so that you can be financially independent in 10 years or less. And in this masterclass, every week, twice a week, actually, we discuss at least one area of finance, typically a high growth company that you can invest now and which is likely to become a household name or down the road, 5 years, 10 years down the road. So today in this series, we will cover Samsara. And if you want to actually follow along all the information that we will discuss in this masterclass, please go to Zillion, search for us, Zillion, Xillion on Google. We should be the first result. Or go to zillionapp.com and just log in. And when you log in, go to this product called Analyze. And when you click on Analyze, you can then select any particular stock and then see all the data that we have collected. A lot of it is proprietary data that you won't see anywhere else. So let's search for Samsara. And here we are. So this is Samsara. You can also save it, bookmark it, so that you can mark it as a favorite and quickly get access to it as you need. So with that, let's talk about Samsara. And first off, let's start with what does Samsara do? And based on my reading, I've talked to many people. A lot of people don't even know it's a public company, so much so that I talked to a customer of Samsara and they didn't know Samsara is a public company. It's not a well-known company. It's not a household name. If you are in a particular business and that business involves managing a fleet of vehicles, whether it's construction vehicles, trucks, delivery trucks, and so forth, or some other kind of big assets, then you are likely to have heard of Samsara. Other than that, ordinary people wouldn't come across any product from Samsara. So what is Samsara? Samsara actually builds products that help companies which have a lot of big assets that move around, help them manage those assets. Let's take one example. A company, a friend of mine, he has a truck company in Southern and Central California. He has hundreds of trucks, and his trucks go from West Coast to East Coast, South, all over the place. He has to figure out where his trucks are so that he can schedule them for the next run and schedule the loads. Also, he can figure out how many miles have the trucks driven? Do they need some kind of maintenance based on miles? And how, if it's a refrigerated load, he has to keep track of, has it been in what kind of temperatures it has been in, what is the temperature of inside that refrigerated truck. So he can monitor all of that for, dozens or even hundreds of his trucks with Samsara as its technology. And one of the products Samsara makes that, you can find very relatable is Samsara actually builds cameras, dash cams. So the truck drivers, for instance, there are a lot of wrong lawsuits against them, people trying to take advantage. And with cameras that actually show that, hey, driver was focused on the road and also the other person was trying to take advantage, this reduces their risk, reduces their liability, and they're able to operate more efficiently, more effectively. And it also is much more safer, right? It monitors using machine learning and AI. It monitors whether the driver is alert, paying attention, and so forth. So overall, a whole lot of products built in, for these, whether it's drivers, operators, and also the owners and the companies. But most importantly, Samsara brings it all together into one platform. So think of it as an ERP system for a trucking company or for even a public transport. City of New York might operate, let's say, 5,000 buses. Those are assets. They want to know where each bus is at any point of time. Something like Samsara could become their one place where they keep track of all those things. So this is always a hallmark of a great company, is when they become almost like the de facto platform of choice for a particular segment, for a particular niche in the market. And Samsara happens to be that. And you can go to their website and see, what they do. Again, they started with small, but they are obviously, like any good company, they actually move up and serve bigger and bigger customers. And you can see their like the customers, DHL, XPO. These are really, really huge companies, and they tend to use it as well. And my friend, as I said, he probably has 50 or maybe 50 to 100 trucks, and he uses it as well. And he said this is the first thing he does when he starts his day at work, is he looks at Samsara dashboards and see where things are at. So that's how critical. That's the hallmark of an ERP system. So without this system, his business will be severely hampered. So you can imagine that how good the revenue model is, that people who have large fleets depend on Samsara for managing all that. And with that background knowledge, let's jump in and take a look. And actually, before we go into that, let me actually do a little bit of a deep dive. Actually, we'll come back to it. So here's Samsara. Overall, if we look at it, it's a $20 billion company. So it's not a teeny weeny company anymore. It's a decent sized company, but it only went IPO about 3 years ago in 2021. A lot of companies were IPOing, but the company only started in 2015. So it's a very young company going into its 9th year. So a very young company. The stock is actually hovering at all-time high right now. Sorry, this number is not right, but you can see over the last year to date, 25% up. In last 1 year, it has doubled. In the last 3 years, it was up and then down. In October, the market had bottomed. October, November of 2022. That's when it was. You could have bought it at under $10, but now it's at closer to $40. And if you look at so this is when they IPO'd in about their 20s, and the price dropped to single digits, and then they have climbed back up. And now they're closer to $40, and they crossed 40 as well. So overall, they have done decent well, especially lately. And if you look at the overall stock performance, their overall growth rate over the last 3 years is 90%, which is really, really high. It puts them right up there with the heavyweights. Not like Nvidia. Nothing is like Nvidia right now, but it's a really, really great growth. Let's take a look at its valuation. Overall, the valuation price to sales ratio is 22, which is decent high, and which we make note of it. Samsara's price to sales ratio is higher than most of its competitors. And the reason for that is because it's one of the highest growth companies right now in its space. If you compare it with, let's say, Johnson Controls and others that are in the similar space, this is just way, way better. And it has cornered a market, right? So it's a very high growth company. Price to earnings, it's a great metric to look at once a company is more mature. When the company is growing as Samsara is, they just put all their extra cash into growing the business, hiring more engineers, hiring more salespeople, R&D engineers, building a better product, doing better marketing, and they just want to capture the market for the long term. So for a 9-year-old company, earnings is maybe a little too early to look at. Now let's look at growth. And this is where we mark it as a very high growth company. Earnings per share, again, for a growing company, not the best metric, but look at the year-to-year sales growth, close to 50% over the last 5 years, close to 70%. This is pretty much as good as it gets, except NVIDIA. NVIDIA is, something else right now out of this world. But for any company to grow at 50% in its 10th year of existence, and a public company, it's very, very rare. And it's growing higher than 98% of its peers. Also, if you look at it, it's earnings per share growth, we'll come back to it. Profitability is low. And as I said, again, keep in mind, this company has software-like gross margins, right? 70-80% gross margins. That's pretty much software-like. Even though they do make a lot of hardware, but their pricing is more subscription-based. That's why their margins are high, and they're able to, get the customer and then keep the customer for a long time, and their margins are very high. Net margins are really, bad because they are plowing all their cash back into the business to grow the business. So they're really not focused on making a margin, paying a dividend, and all of that. They're just growing the business, and they're actually pretty open about it. If you go to their own website, I think they make a point of highlighting that they have put a few $1 billion, right here. So $2.8 billion into the solution. So all the money they make goes back into making the product better, making the platform better. Again, the gross margin is, it's still better than 60% of its companies, of its peers in the segment, tech segment. So overall, still doing pretty well. And imagine this, a company with this much gross margin and 50% growth year over year. And you can imagine how it is likely to become very profitable as and when they want. Okay, now let's look at a few other things. Actually, let's look at a few more numbers here. Look at the revenue. I mean, this is as good a chart as you can imagine in financial world. The year-over-year growth from 2020 to 2021, 100% growth, 22, 70%, 50%, 43%. It's still very high growth. And if you look at quarterly numbers, again, growth accelerated in the last quarter. So this gives you an idea that it's actually not a cyclical business. It's really, they're finding their stride, and they're at more than $1 billion in run rate at this point. And you can see that the growth is accelerating. It kind of had leveled off here in the 40s, and then it's accelerating again. Trailing 12 months, again, a really beautiful graph of just consistent growth over time. Similarly, if you look at the gross profit overall, again, two-thirds of $1 billion in gross profit, which they're putting back into the business, and quarterly, now at a run rate of $200 million in gross profit. So overall, healthy growth in profit as well. Operating income, because they're investing in the business, they are taking a loss in terms of the gap, reporting. But you can, all this money is going into growing the company over the long term. And then price ratio, this is important to look at. PE ratio, they don't have profit, so it's not applicable. But price to sales ratio, you can see that when the market was in the doldrums back in 2022, the price to sales ratio of all the companies were declining. I invested in the company around this time, $12, $13 per share, when the price to sales ratio was about 10. But for a high growth company, that was very low. But over time, the market has realized that this is a very high growth company, and the market is actually paying more. And price to sales specifically is for each dollar in revenue that Samsara makes, the market is saying, hey, you are worth $23 in market cap. So that's how it's calculated. And you can see now the market is saying $23 for each dollar of revenue that you make. eventually, for comparison, anything 10 is considered good, over 10 is expensive, but the very best companies can actually command that kind of premium. So you can see that. Over time, this number will settle at a place. For software, it settles above 10. For, let's say, automotive, if we, let's say, look at Toyota, right? If we look at, say, actually, we were looking at Toast the other day, and you can see for Toast, if you look at price to sales ratio, and it kind of is leveled at 3 to 4. So the market kind of figures out a way to place a certain particular company, and it stays there. So 3 to 4 for this. I would imagine in the long term, this will settle between 10 and 15. So we'll see. But I would say that's like 3 to 5 years from now. So again, very healthy growth is driving even premium in price to sales. We have discussed the margins. Again, the operating margin loss is shrinking. They can turn it on and anytime say, hey, we're going to make profit, and they can start investing a little less. But my guess is they're exploring more industries, building more products. So they think that dollar is better spent on those initiatives rather than showing a profit and then paying a dividend or buying back stock and so forth. Okay, if you have any questions, feel free to ask. Otherwise, I'll go into a little bit more detail about other things. Okay, pricing model. For any company that is young, McDonald's pricing, it's down to the science now, right? They know the price elasticity and all of that. But for a company that is only 9 years old, getting pricing right is important. And some companies, like I discussed Toast some time ago, very transparent pricing, very easy to understand. Samsara, less so. If you are a fleet operator and you try to find price on their website, it is very, very hard. You have to go and jump through the hoops. You have to answer 15 questions. I understand that some context is needed, but this means that pricing is not transparent. That's why we are giving it only 3.5 out of 5 possible stars, because I think pricing is a lever that companies can use to grow, and keeping it simple keeps the organization highly focused on the right things and not just monkey around with pricing. Set the pricing and let the market decide whether that's low or high. And once you figure that out, just go with it. And because people know, right? Even if you don't show it, people talk to each other. People who work in, say, public sector have friends who work in public sector, and they talk to each other. They figure out, and they go to conferences. They meet at social gatherings. And so I think transparent pricing is better, and I think it helps a company. Okay, product diversity. This is where I think Samsara has done extremely well. Actually, they wanted their name suggest IOT, Internet of Things. I think they wanted to do something about monitoring quality in the factories, and then figuring out how to process those images to do the quality checks and all that, and then relay that information to a central place. But eventually they settled on fleets and fleet management. But if you look at their product catalog, they do video-based safety things, telematics. They do software in terms of the whole platform. They do hardware, they do software, they serve all these industries. So they're doing a lot of things. Their product, if you ever are tracking a company, a public company, and their product portfolio, their solutions portfolio looks something like this, it is generally not a bad thing, as long as they know what they're doing, right? They're not stretching themselves thin, but as long as they go to one market, capture that market, move on to the next adjacent, and it seems like they're doing that. They're finding their video-based safety thing could actually work in K through 12 as well, to monitor the kids and the driver behavior. Well, now they're capturing yet another industry, even though the solution was built first for a different industry. And that is possible, right? And again, they're continuing to innovate, continuing to launch new products, but all that stems from one particular thing, which is their leadership. This is where I think Samsara stands miles apart from most of the competition. Their leadership quality, in my opinion, in our opinion, it's 5 out of 5. It doesn't get any better than this. Sanjeet and John, they both, went to Stanford and Cornell for undergrad, respectively, and then they met at MIT during grad school. So they have known each other for what now, 15 plus years, 20 years, right? So it's kind of like growing up together, right? As like adulting together. And before founding Samsara in 2015, they founded another company called Meraki, which Cisco bought for, I think, a few $1 billion. And even there, Sanjeet was the CEO and John was the CTO. And then they stayed with Cisco for a year, and then they started Samsung. So you can imagine, they're such good partners in running a company. John is the CTO at Samsara, Sanjeet is the CEO, and they have been working with each other for decades. And they're still decent young. They're probably in their late 30s to early 40s. So they have a long runway ahead of them. And this is a public company. They have found a niche. And they're both engineers. And I think they're having a ball building new products, testing new products, launching new products. And I think this is the strength of Samsara. So I invested initially in 2022. Then I doubled down earlier this year, about 3 months ago. I bought more stock. And the biggest reason is that this leadership is capable of taking this company to an unprecedented height. So with that, what is our overall recommendation? We strongly recommend that if you don't have Samsara, you think about adding Samsara to your portfolio for the long term. What's going to happen to its stock price in next year or 3 months from now? I have no idea. But 5 years from now, 10 years from now, you look at their product portfolio, it's going to keep growing. Their industries are going to keep growing, and they're going to continue to be leaders in more and more industries. And at some point, all these graphs I showed you about negative profit, it's going to turn positive. It's inevitable. It has happened over and over again. Tesla, Facebook, you name it. Any company that grew insanely fast eventually became profitable because you can only hire so many people and build so many products before there isn't enough initiatives for you to put money in. So it will become profitable at some point. If you have any questions, that's all I wanted to cover in this masterclass. All the information that I discussed here is available right here under the analyzed product within Zillion, or you can just go to my.zillionapp.com/stocks/IoT, and you will see all this information right here at your fingertips. So feel free to explore this. If you have any questions, feel free to put them here, or just speak on the mic, or you can actually just ping me later as well. So if you have any questions, let me know. Otherwise, I'll see you in the next masterclass. Thank you so much for tuning in. And next one, again, we'll explore a company that is not as well known, but has a very high potential for long-term growth. So don't forget to tune in next time when we do this, and we do the masterclass every Tuesday and Thursday every week. Thank you so much for joining.